Namaste. In this video, we will discuss about Indian Accounting Standard 2 that talks about accounting transaction of inventory. We will discuss about the objective of IND AS 2, scope of IND AS 2, definitions used, measurement techniques for valuation of inventories, recognition of inventory as an expense and disclosure requirements. Objective of this IND AS 2 is to prescribe accounting treatment of the inventory. When we do the transactions of inventory related to inventory, we come across some issues that what is the inventory, how the cost of inventory is to be determined, when the inventory is to be recognized as an expense in the financials, how the net realizable value of the inventory is to be calculated, and what are the cost formulas that we need to use for valuation of inventories. This IND AS 2 is applied in accounting for the all inventories except financial instruments and biological assets. These two type of category of inventories is completely exempt from the requirement of IND AS 2. Apart from this, there is some limited exemptions in respect of the measurement requirements. And there are two categories. First category is agriculture product, forest product and minerals if these are held by producers and valued at NRV. We need to take care that this exemption in respect of agriculture products, forest products and mineral is in respect of the measurement requirement and if these are held by the producers and valued at NRV. Second category is commodity. It is also exempt from measurement requirements if it is held by brokers and traders and valued at fair value less cost to sale. What constitutes an inventory? As per IND AS 2, inventories are the assets those are held for sale in ordinary course of business. So we need to check the purpose for which these assets are being held. If these are held for sale and entity is in business of selling those assets, it will be classified as an ordinary sale and those assets will be classified as inventory. But if entity has held for sale some asset but that entity is not in business of selling those assets, it will not be classified as an inventory. For example, a car manufacturer who is going to sell some of its machine. So those machines are although held for sale, but it is not the ordinary course of business of that entity, so will not be classified as inventories. Some other assets are work in progress. Assets those are in process of production of a sale will be classified as an inventory, and assets those are held in form of material or supplies to be consumed in the production process or in rendering of services will be classified as an inventory. So there are some examples that merchandise, if an entity is procuring something from outside and selling it in market or exporting it outside, it will be called merchandise inventories. And finished goods are example of inventory. Semi-finished goods that is in process of production of such sale will be classified as an inventory. Raw material, it may be chemical, steel, resin, plastic, electronic chips, anything that is used for making the finished goods will be classified as an raw material inventory. And spare parts and consumables will also classified as an inventory. IND AS 2 does not specifically deals about the spare parts, so we need to check whether spare parts are the assets as per IND AS 16. If these are the assets as per IND AS 16, then we need to capitalize those spare parts. If it is not classified as PPE, then it will be covered under IND AS 2. Net realizable value is selling price of inventory in ordinary course of business minus cost of completion. For example, estimated cost to be incurred for converting the semi-finished goods into finished goods minus cost to make sale in ordinary course of business. So in summarized form, we can say NRV is estimated selling price minus cost of completion less cost to make the sale. Now we will discuss about the measurement of inventory. Basic rule in this respect is inventory will be measured at lower of cost or NRV. There are two exceptions in this respect that we have discussed earlier. First is in respect of producer of agriculture products, forest products, mineral and mineral products. If they are valuing their inventory at NRV, this rule will not be applicable. And in case commodity dealers and brokers, they are valuing their inventory at fair value minus cost to sell, this rule will not be applicable. Cost of inventory includes the purchase cost of inventory. It includes the purchase price, the transportation cost, non-refundable duties and taxes that we have paid to procure the inventory, commission and charges if we have incurred for purchasing the inventory, and we will reduce the trade discount that we have received in process of purchasing that inventory. Next is the conversion cost of raw material to finished goods or semi-finished to finished goods. It will include the material cost, production overhead, labor cost directly attributed for production of those inventories. Next is any other cost that we have incurred to bring the inventories to their present location and conditions will be included in cost of inventory. And there are some exceptions, exclusions that we will not include in cost of inventory. These are any abnormal waste that has incurred in production process related to material, labor, and any other thing. If, for example, if there is any strike that has been there and we have to pay for the labor charges during that period, and if there is something abnormal material loss that has occurred that is not in normal course of business, it will not be included in the cost of inventory. Next is any storage cost of the material. If it is required in production process, it will be included in the cost of inventory, but if it is not required for production process, then it will be excluded from inclusion in cost of inventory. Next is administration overhead, like cost of accounts department, treasury department, or any other department that is not directly related to the production processes of the inventory. And selling expenses will not be included in cost of inventory. Now we will understand the concept of capacity loss. As per IND AS 2, all the fixed conversion cost will be loaded on the inventory based on the normal capacity. So what the normal capacity is? As per IND AS 2, it defines normal capacity as an expected production to be achieved on an average number of period or season under normal consideration. When we look at the conversion cost, we can divide it in two parts. One is the variable conversion cost, another is a fixed conversion cost. In case of variable conversion cost, all the variable conversion cost will be loaded on the inventory irrespective of the level of capacity achieved by an entity. But the capacity loss concept arises in case of the fixed conversion cost. If the actual capacity is greater than the normal capacity, that is, there is an overutilization of the capacity of an entity, in that case all the fixed conversion cost will be allocated to the inventory. But in reverse case, where the normal capacity is greater than the actual capacity, we need to the book capacity loss for underutilized capacity. Let me show you how it works. If an entity is having normal capacity of 100 and the actual capacity is 70, in this case there is an underutilization of 30% of the capacity. So all the fixed conversion cost by 30% will be booked in profit and loss account instead of loading to the inventory. Only 70% of fixed conversion cost will be loaded on the inventory. So we will book capacity loss, debit to the profit and loss account, and we will reduce the manufacturing labor cost, manufacturing other expenses in manufacturing statement by 30%. IND AS 2 permits two cost measurement techniques. One is standard cost method and another is retail cost method. Standard cost method mostly used in manufacturing industries, and retail method is used where there are large number of items and person is involved, entity is involved in trading of those items. When we sell the inventory, we need to book cost in profit and loss account. IND AS 2 permits few formulas to measure the cost of inventory to be recognized. In this respect, first we need to check whether the inventory that we have sold is interchangeable or is produced or segregated for a specific purpose. Now the question arises, what is interchangeable? This is something that we need to decide based on the judgment, and it should be carefully exercised. For example, crude oil procured locally and imported crude oil may not be interchangeable because their credentials may be different. The yield ratio of both the crude oil that is imported and locally procured may be different. So it will not be called interchangeable. So it's a matter of judgment to decide what is interchangeable is. In case if the inventory that we have sold is interchangeable, then we need to apply a specific cost method to book the cost of the inventory. In the reverse case, if it is not interchangeable, in that case, IND AS 2 allows two cost formulas. One is first in, first out method and another is weighted average method. Third method, that is last in first out method, is not allowed as per IND AS 2. And we need to use same formula for all the inventory having the similar nature in respect of the geographical operations we have. If the use and the nature of the inventories are same across the entity, same cost formula will be used. We need to recognize inventory in our books of account at lower of cost or net realizable value. NRV we have already discussed that it is selling price minus cost of completion minus cost to make the sale in ordinary course of business. In case NRV is lesser than the cost, that we need to write down the inventory value to the NRV value. So we'll have to book the devaluation loss. Now we'll see how the accounting flows in these cases. When we are selling the inventory, we'll debit the cost of goods sold and we'll credit the inventories. If NRV is less than the cost, then we need to book the devaluation loss. In this case, we'll debit the devaluation loss in P&L and we'll credit the inventory valuation allowance. We need to evaluate inventory on a regular interval, and if in case NRV is greater than the cost, then we need to reverse the devaluation loss we have booked in respect of that inventory. In that case, the reversal entry will be passed, inventory valuation allowance will be debited, and devaluation we booked earlier will be reversed. So now we will discuss about the disclosure, extensive disclosure requirements that has been given in IND AS. We need to disclose the accounting policies that we have adopted, the total carrying amount of the inventory and carrying amount in classification appropriate to the inventory entity, carrying amount of inventories carried at fair value less cost to sale, amount of inventories recognized as an expense during period, the amount of any write down of inventory recognized, the amount of any reversal of any write down that is recognized as a reduction in amount of inventories, circumstances and events that lead to reversal of write down of inventories, and the carrying amount of inventories placed as security for liabilities. This is the basic introduction of IND AS 2 inventories that we have discussed.